If 30% of the global oil supply goes offline indefinitely, the price per barrel immediately shatters the $200 mark. Treating this strictly as a transportation crisis or an energy shortfall is a fatal strategic error. The fuel pump is the least of the global economy's problems. This node graph shows crude oil's true footprint. Refined petroleum derivatives are the direct inputs to manufacture plastics, pharmaceutical drugs, and agricultural fertilizers. Removing a third of this central feedstock stalls the global manufacturing base and immediately fractures food security, making industrial-scale crop yields physically impossible. This instantaneous break in the petrochemical supply chain threatens the stability of the global system, triggering a violent, panicked reallocation of institutional capital. The resulting panic forces the global economy down Maslow's hierarchy of needs. Capital abandons higher-order technological ambitions and sprints toward basic physical survival. With domestic infrastructure damaged, sovereign wealth funds in the Gulf, abbreviated as SWFs, state-owned investment funds, are forced to halt outward liquidity. That means instant freezes on commitments to $100 billion frontier AI models and megaprojects like the Neon Tech City. This Sankey diagram illustrates the rapid macroeconomic inversion. The liquidity pipeline that previously sustained enterprise software and speculative tech reroutes entirely and pours directly into agritech for food security and domestic energy independence infrastructure. The market must urgently answer one question: how do you physically build the modern world without its primary raw ingredient? The only viable path forward is to bypass crude oil entirely. Heavy industry must pivot to alternative synthetic chemical pathways, specifically coal to chemicals, known as C2C, or power to X, referred to as P2X. Coal to chemicals is not a new theory. Historically, isolated states deployed C2C at scale to maintain supply chains and hedge against maritime blockades. Driven by its own energy security mandate, China has spent the last decade scaling this infrastructure to massive proportions, mining vast reserves of raw carbon. The process begins by superheating raw coal to roughly 1,300 degrees Celsius inside a gasifier. This strips the coal down into syngas, a volatile mixture of carbon monoxide and hydrogen gas. That syngas is then routed through a process called Fischer-Tropsch synthesis. Fischer-Tropsch synthesis is a set of chemical reactions that convert carbon monoxide and hydrogen into liquid hydrocarbons. The output provides the exact same olefins, plastics, and liquid fuels normally refined from crude oil. This completely isolates their manufacturing base from the chaos of a global oil shock. China already has the physical industrial reality to synthesize missing materials. By 2024, Chinese C2C plants were already converting 276 million tons of coal, and the sector is on track to double that capacity within 5 years. This chart compares the unit economics of chemical precursors under extreme market stress. With oil crossing $200 a barrel, traditional petrochemical suppliers operate at a deep loss, losing 200 yuan per ton on olefins. Meanwhile, coal-based olefin margins soar to a profit of 800 to 900 yuan per ton. The same chart transition shows the advantage in natural gas pricing. Domestically produced coal to gas costs roughly 2 yuan per cubic meter, making it 30% cheaper than importing liquefied natural gas at 2.87 yuan. These margins are achievable because the infrastructure is funded by state-owned enterprises with ultra-cheap capital, allowing for massive projects like Baofeng Energy's 48 billion yuan conversion plant. While traditional global refineries bleed cash trying to source expensive crude, Chinese C2C operators are capturing massive windfall profits from cheap domestic coal. Coal to chemicals has a severe limitation. It is incredibly carbon-intensive. The primary alternative to this is power to X, or P2X, which uses renewable electricity to synthesize clean hydrocarbons from scratch. The foundation of all P2X is an electrolyzer. An electrolyzer is a device that uses electricity to split water into hydrogen and oxygen. When powered by a renewable grid, it produces pure green hydrogen. By capturing carbon dioxide and combining it with that green hydrogen, a process called methanation, you produce synthetic methane. This perfectly replaces natural gas imports without drilling a single well. Alternatively, you can merge that hydrogen with atmospheric nitrogen through the Haber-Bosch process. The Haber-Bosch process is an industrial procedure that artificially fixes nitrogen to produce ammonia. Doing this with green hydrogen yields e-ammonia, directly solving the agricultural fertilizer crisis. Power-to-X secures the supply chain without the carbon penalty, but it is currently strangled by a lack of global electrolyzer manufacturing capacity and much higher upfront costs than coal. The market faces a stark choice: rely on economically dominant but highly polluting coal, or wait for clean but expensive and bottlenecked electrochemistry. The immediate solution is a hybrid system. In November 2025, China brought a commercial project online physically blending heavy C2C output with P2X green hydrogen. By injecting pure green hydrogen directly into legacy coal gasification, operators artificially balance the chemical ratio. This maximizes the yield of usable plastics and fuels while drastically lowering the overall carbon footprint. No new mega plants need to be constructed from scratch. Pragmatic operators are bridging existing dirty coal infrastructure with clean electrochemistry to optimize their output today. Trillions of dollars spent over the last decade on climate infrastructure were widely criticized as economically inefficient. Now, those exact installations serve as the critical emergency manufacturing base for a forced energy transition. The clear corporate victors are companies that already built out their production scale. Firms like Tesla, BYD, and CATL are perfectly positioned to absorb the surging demand for electric vehicles and heavy battery storage as oil becomes impossibly expensive. Meanwhile, scaling Power-to-X requires an immense, continuous supply of electricity. That demand is triggering a global renaissance in nuclear power construction to provide the steady baseload that wind and solar cannot guarantee. When global supply chains fracture, the ultimate geopolitical advantage belongs to any nation capable of producing its own energy, whether through domestic shale, uranium, or captured sunlight. Looking at the map, Indonesia emerges as uniquely equipped to dominate both ends of the synthetic hydrocarbon spectrum. On the legacy side, they control 39 billion tons of raw coal reserves, providing the immediate carbon feedstock to spin up a domestic C2C sector. Looking toward the future, Indonesia also holds 40% of the world's geothermal capacity. Geothermal power harnesses heat from within the earth to generate electricity, providing a massive, uninterrupted clean power source for future P2X electrolyzers. Nations holding both vast reserves of raw carbon and scalable, continuous renewable power possess the required feedstocks to dominate the next era of global manufacturing. The immediate directive for global businesses is to aggressively audit their supply chains. If your operations rely on specific plastics, industrial resins, or agricultural fertilizers, you are highly exposed to the Middle East shock. Investment funds must freeze commitments to speculative software and reallocate capital into companies with deep chemical engineering expertise. The era of relying on a steady, cheap flow of globally traded crude oil is indefinitely suspended. We are now entering a localized scramble to build synthetic chemical infrastructure. The smartest capital in the world is already buying up physical infrastructure and carbon feedstocks. Supply chain models that fail to integrate alternative pathways like C2C and P2X simply will not survive this transition.